Markets have been going down amidst signals of an impending recession, but one particular market will be affected. The automotive industry will suffer significantly due to a combination of factors. Join us in today's video as we cover Cathie Wood's perspective on why the industry is bound for tremendous losses. Within a matter of months, the downturn that hit the automotive industry in 2008 took out hundreds of billions of dollars. Automobile manufacturers all around the globe were fighting a losing battle to endure a dramatic decrease in sales. The federal government of the United States provided financial assistance to General Motors and Chrysler, while Ford was required to obtain a loan from the government. Toyota recorded its first loss in 7 decades, and Honda's automobile sales decreased by 31.6%. In the blink of an eye, dealerships were wiped out and pushed to make long-term reforms. The automobile sector, which was worth $2.8 trillion, collapsed instantly. What our predicament is twice as bad. This is what a leading indicator is demonstrating, and Cathie Wood, the Chief Executive Officer of ARK Invest, has recognized the issues. There is significant difficulty on the horizon, and people all around the world are soon to awaken to an absolute catastrophe. It is widely acknowledged in the business of finance that the University of Michigan Consumer Sentiment Survey is one of the most trustworthy surveys available. The survey asks a very compelling question. Speaking of the automobile market, do you think the next 12 months or so will be a good time or a bad time to buy a new vehicle such as a car, pickup, van, or a sport utility vehicle? Since this topic was first posed in 1961, there is a substantial body of information available to use as a point of reference. The percentage of respondents who believe it is currently an unfavorable moment to buy a vehicle has reached all-time highs, as demonstrated by the chart. The current degree of customer dissatisfaction is the highest it has ever been at any point over the survey's existence. The demand for automobiles is said to be solid, despite this graph showing the opposite trend. But there is absolutely no truth to that statement. It is not a lack of demand that is driving up the price of automobiles. Instead, there is a supply shortage. The number of items held in stock by dealers has reached an all-time low, which is directly contributing to the dramatic rise in pricing. The demand from customers for automobiles is also at an all-time low, which mirrors the number of goods that are now available. Automobile manufacturers are rushing to place orders for new semiconductors for their automobiles, but it is doubtful that there will be sufficient demand by the time the chips are shipped out. Consumers are being forced to wait for innovations since the automotive industry is in the midst of a rapid transition towards electric cars. To add insult to injury, car costs continue to rise year after year, putting the automobile sector in grave danger. The typical cost of a brand new vehicle has climbed by $11,000 over the course of the last 3 years, which is having a negative impact on consumer morale. According to research conducted at the University of Michigan, low consumer morale can be attributed to high pricing. This illustrates that the pricing of automobiles cannot be maintained for an extended period of time. Used automobile prices are rising more slowly, as the Manheim Used Vehicle Value Index clearly shows. Car prices cannot continue to rise at this rate indefinitely, as is well understood by the general public. Due to an enormous pricing bubble and a growing supply that is outpacing demand, automakers and dealerships around the world may find themselves with an oversupply of vehicles. A glut occurs when a product is oversupplied, resulting in a sharp decline in its value. Chip supply concerns are reportedly beginning to ease, according to Elon Musk, Lisa Su, and GM, all of whom have made similar statements. This is what ARK Invest, and specifically Sam Corris, has been focused on in regards to this subject matter. There are already indications that automobile sales will recover from the recent semiconductor scarcity. Recent estimates put the number of automobiles sold in January 2022 at 15.5 million, which is an increase of approximately 20% compared to the previous month's numbers. This is definitely a significant rise, and it is very probable that it satisfies the lingering consumer demand that was caused by the supply constraint. Immediate supply issues are anticipated to arise if and when the public's want for more expensive cars is fulfilled. As a result, Cathie predicts that the automobile industry will experience its most severe price collapse ever.
In the survey, deeply buried in the survey, there's a part that says, or asks the consumer, is now a good time to buy a car? And I hadn't looked at this statistic in quite some time, but it has dropped to a new low, 46. It is lower than the low in 08-09, which was roughly 100. And pre-COVID, it was running at 150. So it's about a third of that. And it just dropped to a new low. Now, this flies in the face of what we saw in January. Auto sales moving up quite strongly from 12.4 million units in December to 15 million in January. And what we believe has happened there is the various automakers had been building up inventories at the factories or near the factories, just waiting to put in chips, as we heard all about the chip shortage during the last year. And so they are now saying that chip shortage is alleviating. So there have been people waiting for their orders to be delivered. But if this survey is right, there's not going to be much follow-through.
While the auto sector as a whole faces imminent collapse, it is not just autos that will be affected. The total amount of inventory held by businesses has recently shown signs of significant growth. The inventory to sales ratio has increased by 3.2% to 1.29 in December of 2021. Even though a 3.2 rise might not sound like much, that number represents a 38% increase yearly. A rise of this magnitude is consistent with new supply factories beginning to get their production levels up to speed. Before the presentation began, AMD CEO Lisa Su provided this explanation. According to Lisa Su, the supply issues have prompted a number of enterprises to make investments in new supply operations. However, these supply strategies aren't put into action instantly. The typical time required to begin the development of a supply plan ranges between 18 and 24 months. The majority of companies made investments in supply plans at the end of 2020, which places the timing for supply recovery somewhere between the beginning and end of 2022. Cathie's theory hasn't been proven correct just yet, despite the fact that she has been expecting for some time that good prices will drop. As a result, the value of ARK Invest's ETFs has significantly decreased. On the other hand, if she is right about the future patterns, then the entire globe is in for a significant surprise in some way. There are two long-term trends that affect inflation. The first is disruptive innovations competing with traditional businesses, which makes prices come down because there is more competitive pressure. A good example of this is the automobile business. Gasoline-powered automobiles face competition from hybrid and electric vehicles. Because there is now more competition than ever before, costs for gas-powered vehicles will need to go down in order for them to remain competitive. In addition, technological advancements have resulted in lower prices as a result of greater production effectiveness. If we consider the example of automobiles that we previously discussed, electric vehicles are the best example of how costs might be reduced. As battery prices continue to fall, electric vehicles will become more available to the general population in the future. This particular kind of innovation is inherently inflationary due to the fact that it enables customers to purchase things at reduced prices. The second factor contributing to inflation is cyclical, and it's the expansion of inventories, which was covered previously in this video. Earlier this month, Cathie appeared on CNBC to discuss her views on inflation. Her theory hinges on the fact that she thinks that inflation is driven by supply rather than demand, and that, as a result, it will ease off as supply catches up to demand.
The supply chain issues have lasted so much longer than we anticipated that they would take a while to work out, but not 2 years. So the question is this supply chain related? And will these inflation metrics unwind? I think a lot of what's going on is supply chain related. I know it's become unfashionable to use the word transitory, and so we won't, because it's lasted longer than we expected. However, I do think there's going to the deflationary forces that are building up in the economy today are pretty strong. Two are secular, one is cyclical. And the bond market is sort of getting this. If you look at what's happened to the yield curve, so the difference between long rates and short rates, it has flattened from, I think, 155 basis points last March to 45 basis points today. And if the Fed did go 50 basis points in March, which they might, I think that it would be one and done then, we'll end up with an inverted yield curve. And then what are people going to think? Well, an inverted yield curve and the flattening yield curve says, watch out, something's going on here. Either growth is going to disappoint or inflation is going to be much lower than expected, or both. And we think both is right. And so that's the cyclical source. There's an inventory buildup. If you look at the record-breaking inventory buildup in the fourth quarter GDP report, you'll get a sense, while inventory to sales ratios might be low, as the consumer switches off here. And if you look at the last 3 months of either retail sales or consumption, the consumer has gone pretty flat. Meanwhile, you've got the double ordering and triple ordering by manufacturers and wholesalers because they were missing sales before. So I think there's a big inventory problem brewing here, and it's going to hit within the next 6 months in terms of that recognition. That's the cyclical side of inflation.
When it comes to economics, the automobile business is an excellent example of how it all works. During the course of the past year, there has been an alarmingly low level of available inventory, which has contributed to the rapid rise in price. In the past year, prices for brand new automobiles have climbed by almost 12%, which is clearly unsustainable. This is comparable to the rising prices paid by consumers across the entire economy, which has been doing so at rates that are cause for alarm. The level of consumer demand is at an all-time low right now, which is the most important thing to understand about the current state of the macroeconomy. Similar to how there is a shortage of chips in the automotive sector, inventories around the world are beginning to rise. The price of used cars dropped by almost 20% during the crisis of 2008, which was an awful lot at that time. Once the new supply facilities enter the system, this will be the ultimate blow of 2022, and it will result in a significant economic downturn. Nevertheless, considering the enormous rise in the cost of used automobiles, a 60 or even 70% decline may be expected to revert prices to their previous levels. As the supply crunch eases, the automotive sector's bubble is poised to pop. What are your thoughts on the automobile market? Do you guys think it will be able to bounce back from the impending downturn? Comment your thoughts in the comment section down below. If you enjoyed this video, kindly like and subscribe.